Good morning, good afternoon, good evening, depending where you are on the planet, and welcome to the Monday, the 13th of January, Bull versus Bear webinar. Steve Miley here on the Call for Trade Day. Slightly different run through in here today than we usually do during the week for the Monday webinar. Taking a look at what I like to call the shape of the week, slightly bigger picture outlook, looking back for the last week and looking forward to this week. What do we have throughout the whole week? Why do we do this when we day trading at trade day? Because this, again, as I said, gives you an idea of the shape of the week. If we've got bigger events coming up later in the week, then it's a lot more likely to be quieter, in quotes, quieter, meaning potentially less volatility, potentially narrower ranges, and then you might adjust your trading strategy even as a day trader accordingly. Might be more range bound, might be more consolidation themes rather than significant trending themes if we're waiting for significant data, which we are this week in significant events. So let's take a look at both our macro matters. Now, these are available below where you're looking right now. If you're watching this in the members area, live or on the recording, you will see three columns. The left-hand column is our technical analysis. The right-hand column is our news from our partners at LiveScoop. The middle column is where you'll find at the weekend, usually late on a Sunday afternoon, evening, depending on where you are in the world. You will find both the macro matters and the macro summary posted on Sundays, which are summary, just basically exactly as it says on the tin, a summary of the macro matters. Macro matters a little bit more in depth. You can see running over 5 pages here. So we'll concentrate on the summary in here. I'm not going to go through it in too much depth, but basically markets kicked off the year really on a more negative tone, choppy for the first partial week. Last week, again, was a partial week because of the holiday for Jimmy in honor of Jimmy Carter. So we had a Thursday holiday, but nevertheless, markets starting off the year relatively negative, certainly in the US. European markets holding in a little bit better in here. Asian markets also down. And so we've seen that. And that was pretty much driven by kind of two events, really. So we saw the Federal Reserve a more cautious tone in their minutes, highlighting elevated data risk. We did also have PCE inflation data, and then we also had data in here. Actually, I think I've got the wrong report in here open. Yeah, this is the wrong report. I've opened the wrong report in here, but this is the correct report. No, that's the wrong report as well. Sorry, guys, I'm looking at the wrong reports in here. Let me just go back to the trading room, which means we're going to hear, might get a little bit of feedback. Let me just put it on mute at my end. So I'm just going to go back to the trading room here. I've not uploaded the macro matters. Oh, they are. I just popped out the wrong one somehow. Not quite sure. Maybe the wrong ones were up. Oh, here we go. This is the correct ones. I just opened up the wrong ones. My apologies, guys. So let's get the correct two opened up in here. Close those ones down there from December. So, and let me just pop the calendar back out. Okay, my apologies, guys, in here. But yeah, so global equities certainly down, though. That was the main thing. So we ended up starting the year, major equities down. We did get conflicting reports early on, actually, from Trump as well on tariffs. So effectively, report coming out earlier last week saying that there may be a narrower focus on tariffs and not as broad as maybe the markets anticipated, that Trump had hinted at. Then Trump roared back against that, saying no, it is going to be broad. It's going to be broader and bigger tariffs. So, and there is some confusion here. The report initially saying maybe narrower, not as aggressive tariffs, and then Trump kind of pushing back on that a little bit. So we certainly that was a negative for markets. We also had the minutes from the Fed in here, from the December meeting in here. They were more hawkish, and also Fed speakers more hawkish last week, more in a wait and see approach. And then really then having already had those negative effects earlier on in the week, then we were hit with the jobs report, which we were expecting around 150, 160, I think it was 165,000, came in at 256,000. We did a bit of scenario analysis. What we wanted is really not too hot, not too cold, just about right. And so kind of counterintuitively, but we did do this analysis, a hot jobs report. So this is a positive jobs report, remember. It was stronger than anticipated. The market's though reacting negative. Why is it reacting negative? Why are equity markets down? Equity markets down because there's concerns that the strong economy and the fact that inflation is not continuing to move lower, not getting down to that 2% level that the Fed want to see, means that we're seeing potential for the Fed to not cut rates as aggressively. So alongside the minutes which were relatively hawkish, it's not the Fed are going to raise rates. So hawkish doesn't mean they're going to raise rates, but it means they're less dovish, so de facto more hawkish. So we've got a less dovish Fed coming from the minutes, a less dovish Fed. I think it was Bowman spoke last week, as a little bit more hawkish than previously. And then and concerns around tariffs as well, potentially inflationary pressures from tariffs. So all of this, and then the jobs report. No, why would the Fed be cutting rates when there's these potential inflationary pressures, particularly potentially coming through from the Trump administration, where the jobs market is very firm, the jobs market is secure, the jobs market is strong. So no need for the Fed to cut rates, and we'll come to the Fed watch tool shortly, and it's now reflecting a far more well, if you want rate cuts, is a far more pessimistic look on rate cuts. So that's a far more negative look for the outlook for equities. What's the focus this week? Well, we get key inflation data, we get CPI and PPI reports. Obviously, the big focus on CPI data for December coming out on Wednesday, and then we get also on Wednesday the fourth quarter. So for the last quarter, Q4 2024, we get the Q4 2024 earnings report to kick off earnest on Wednesday with the banks and the financials. So we're watching that. So stocks were down last week. European and US bond yields are moving significantly higher. They moved significantly higher on Friday. UK bond yields are surging higher. It's causing real problems here for potential borrowing costs here in the UK. So we've got bond yields are going higher, which means potentially and not as much rate cuts coming in here. Bond yields, and those bond yields are going higher because of concerns around inflation and concerns around the economy. And this is all being driven by anticipation from a more aggressive stance on tariffs from Trump, a more hawkish tone from the Fed, and then also, as I said there, the fact that that hawkish tone from the Fed then is seen as a negative. We've got a robust economy in the US, so why would you be cutting with the robust jobs report that we saw on Friday? So US global equity going down, US bonds selling off, going to significantly higher yields, the strong move higher in bonds. The bond yields as means that the dollar continues to go higher as a safe haven, and with yield differentials favouring the dollar. So US dollar is a multi-year high. Gold futures actually moved to the top end of a multi-week range, probably as a hedge because of concerns around risk-off environments. We're moving into risk-off. Despite the dollar being strong, it should be negative for gold. The risk aspect of gold as a safe haven means that we're in a risk-off scenario, so we're seeing equities selling off, bonds also selling off, which you don't usually see in that risk-off scenario. Bonds selling off. So where's the money going to go? It's going to go into gold. It's going to go potentially into, say, Bitcoin as well. Obviously, with the dollar strong, Bitcoin not necessarily going to be rallying against the dollar. And oil futures also moving to multi-month highs in here. So across the board here, commodity prices pushing higher, gold and oil. Going into this week, as I said, central bank activity is fairly light, but we're going to be watching Fed officials. Do note that we're going to look at the Fed calendar in here. We have the meeting on the 28th and 29th, and so the Fed enters their blackout period this Saturday, 18th. Okay, so we only have this week. We only have the 5 days of this week coming up where we are going to have access to Fed speakers. Then they go on their blackout period to the 28th, 29th. Now, it's pretty much nailed on. We're not going to get a rate movement here. What's going to be really interesting is the statement we get here, from the Fed and the Q&A with Powell, because obviously things have shifted in here significantly. Where we're now looking like, so we'll come to the Fed watch tool shortly. There's potential for no rate cuts, maybe only one rate cut this year. So that's looking ahead. We've got no, where are we? Sorry, let me go back to the calendar in here. So, sorry, guys. Yeah, so we've got no real central bank activity, but watching Fed officials because of the last week. The big data we have is Wednesday's CPI. We also get PPI from the US on Tuesday. But the CPI is the data we're going to be watching. We also get the CPI from elsewhere, UK inflation report on Wednesday as well, and Chinese GDP, and then EU CPI Friday. So Wednesday and Friday, UK and EU CPI. So we're going to be watching them. And as I said before, the Q4 earnings season kicks off with the financials releasing their earnings. We jump to the earnings calendar. If you don't have this already, it's from investing.com. This is the one I tend to use. In here, we can't get this as a widget on our site, which we would like to do. There's no access to this as a widget. But you see in here, I filter this down. So we only have the US, and I have the 3 stars of the bigger companies. Otherwise, you're going to get hundreds of companies in here. So you do that and go for this week, and you can see on Wednesday we get the financials kicking off. So these are before the bell. You can see the little sun on the right hand side. That means before the bell, before the market opens. So watching out for those next coming up on Wednesday. We'll highlight those: JP Morgan, Wells Fargo, Goldman Sachs, Citigroup, and Bank of New York Mellon kicking off the financial earnings season here for the financials. And then as we go through, we got some more on Thursday: Bank of America, Morgan Stanley, etc. And then we, as we go through January, we're going to get move into the tech sector. So so we've got a busy week coming up Wednesday onwards with the banks reporting and the CPI data. If we actually go to the calendar for today, where have I got that open up? So you can see it's fairly light in here, but nothing really of significant note in here coming into today. So you just see positioning. So no real data of note, but I still think it could be an interesting day because the market's definitely on the back foot after that strong US jobs data that we had on Friday. Looking here, the 5 things to start your day. Oh, maybe this is it in here. Maybe it's in the morning briefing. It wasn't up in here. So obviously this isn't helping matters either in here. Obviously the LA wildfires in here causing complete havoc. And then obviously that's cost of billions of dollars. Look, economic damage is $275 billion in it, so that's not small. And that's going to damage the Californian economy, damage the the national economy as well. Sea of red, stocks and bonds extending losses. Traders bets on Fed Reserve interest rate cuts will come to that. Oil prices 5-month high. We've spoken about that. Dollar looking strong. Jamie Dimon is the last way of tariffs. He used large US things that can be useful tool to address unfair competition. So we're going to see where that goes. We won't know more on the tariffs until obviously after Trump's inauguration and China trade service. Nothing in here than the rest of it. It's going to really impact us what we're looking at. So stocks. So these are all saying the same thing pretty much. Stock traders ratify fresh riding bond yields. Bonds are going to be super important at the moment. As long as bond yields continue to go higher, bonds sell off. There's a positive correlation between bonds and equities in here at the moment. So bond prices, I remember, going down, yields going higher, bond prices down, bond yields going higher, bond prices down, and stocks going lower as well. So if we look across the board, global bond, and this is not just the US, by the way, this is across the board, seeing the same thing for European bonds, seeing the same thing for UK bonds. Global bond challenges are wrenching away at starts of the year. US Treasury market is leading a reset higher in borrowing cost potential, rise ranging costs, higher yields. Remember, higher borrowing costs, negative for stocks as well. So all of this is impacting negatively into stocks. Treasury sales ripple through world markets after jobs data, all the same stuff. Jobs report fuels Treasury yield surges, markets brace 5% fresher on the US 10-year. S&P 500 wipes its post-election gains now. Bonds halt, and some of traders cast out over 2025 rate cuts. It's all the same stuff in here. London stocks also slide. Markets wary of global rate access. It's all the same thing. So you need to be watching the bond market, is what I'm trying to say in here today, guys. If bonds start taking out levels in here, you need to be thinking about where they can go to lower bond prices, and that's going to mean stocks lower as well. About 1% lower on both the Nikkei and the Hang Seng over here on the overnights. European markets down, UK FTSE down a third, 2/3 lower on the German DAX, and over 0.75% lower on the French CAC in here this morning. And US futures having been hit on Friday, even more significantly lower, over 1% down on the futures for the Nasdaq, and over 0.75% for the S&P 500. Here's the Fed Watch tool. Now, this hasn't changed. This is the same. So basically, no chance of a rate cut at the January meeting at the end of January. But what's interesting here, if we go to like May, June, when we were starting to get hopes for a rate cut, look, This is unchanged. 425 to 450 is the current target rate. 425 to 450 here. 68% chance by May that we are unchanged. We go to June, 48. So it's almost 50-50 for a rate cut by June. July, though, not quite 50-50, but still 54% chance we get any rate cut by July. Okay, so maybe more of a chance of a rate cut come July. So maybe one rate cut in the summer. By September, still a 37% chance we get no rate cut. So we're looking for really probably a rate cut July, September now is what the market's pricing in. And if we go to October, still 35% chance of no rate cut, and only and then the balance is for maybe for a one rate cut. Very outside chance now for two rate cuts even by October. And then by the end of the year, 31% chance. So basically, a one in three chance we don't have any rate cuts this year now. It's being priced in. And then we've got, it's more like 70% we do get one rate cut, but it's very little chance here. You see, it's only what? So these two together makes that eight. Only a 20, low 20, 25% chance that we get more than one rate cut this year. If we had all these up here, 26, 27% chance we get more than one rate cut this year. So the market very much pricing in maybe only one rate cut, maybe no rate cuts this year now. Haven't been expecting. Remember, at the end of last year, we were expecting 2/3 through the end of last year, two, and now potentially one, maybe none. And that's why we're seeing stocks getting hit. US fixed income. Look at these extension targets we have across the bond yields. I would be putting these in even if you're trading equity indices. If we start taking out these levels on the downside in here on the bonds, 10-year arguably the most important, but you've got all the bonds in here, 30s, 10s, 5s, etc. If we continue to hit negative, it's breaking down through support levels. That's going to lower prices, higher yields, and that's going to weigh on stocks in it. So you need to be higher for that. And then if we go and take a look at the bond yields here, you can see the market is now taken out. If I just pop this out here, I need to narrow this down. You can see we've gone through this high yield point in here we had from April of last year. That was around 4.75% in here now. Above that, the next target's up here, which is closer to 5%. The market in there targeting on the 10-year yields potentially up to 5%, and that's going to take us to a multi-year high if we get above 5%. Look, so this is going back. I don't know where we go sort of 1 week. How far this goes back. Yeah. So look, if we go here, that was the high point in the yields from back here in 2023. We haven't been there for forever, right? For a very long time, since here we're up 2013. So above 5%, above 5% is going to be a multi-decade high for bond yields. So it's certainly going to be watching out if we move towards 5% on 10-year yields. And we've moved negative on the equities in here now. So the market's taken out. We've got now a section of lower lows. We took out the previous lows in here, both the S&P and the Nasdaq. The lows we put in December and January, we've taken out that lows. So now we get not only lower highs, but also now lower lows, and that opens up downside. And we're obviously opposite lower on Nasdaq and 3/4% lower on S&P. So watching out for these downside support levels. We're taking out further support levels today. Watching out for more damage. I do think there is risk of more damage going into today. Probably then rectifies itself. We have consolidation Tuesday into Wednesday when we get the CPI data and the earnings reports. So CPI is going to be all important in here. If CPI doesn't start to moderate and push down, don't start getting better numbers out of the CPI, then we could get obviously higher yields across the board, and that's going to weigh on stock indices going into mid January. All right, guys, I'm going to wrap it up there. I'm going to wish you all a great trading day. Take care, stay safe, and I'll be back with you for another Bull versus Bear webinar tomorrow. Bye.